September 15, 2008. A 158-year-old financial giant collapses overnight. Wall Street freezes, global markets panic, millions of jobs vanish. But here's the unsettling part. The system didn't fail because of a mistake. It failed exactly how it was designed to. So what if the biggest financial crash in modern history wasn't caused by reckless individuals, but by a system that quietly rewarded disaster? In the early 2000s, buying a home in America felt easy. Too easy. Banks weren't just lending money to safe borrowers. They were lending to almost anyone. No income, no stable job, bad credit history, no problem. These were called subprime loans. By 2006, nearly 1 in 5 new mortgages were given to high-risk borrowers. But here's where things get strange. Banks weren't worried about getting their money back because they had already sold the risk to someone else. Imagine you sell a fragile glass vase online, but before shipping it, you buy insurance on it. Then you sell that insurance to someone else. Now, you don't care if the vase breaks. In fact, you profit if it does. That's exactly what happened with mortgage-backed securities. Banks bundled thousands of risky home loans into financial packages, then sold those packages to investors around the world. Pension funds, insurance companies, foreign governments. All told, these were safe investments. Why? Because credit rating agencies gave them AAA ratings, the same rating as U.S. government bonds, even when those bundles were filled with ticking time bombs. Then came the final layer: credit default swaps, insurance on those risky bundles. Now, investors could bet on mortgages succeeding or bet on them failing. And the more fragile the system became, the more money Wall Street made. Then housing prices stopped rising. Monthly payments reset. Borrowers defaulted, one by one, then thousands, then millions. Suddenly, those safe investments weren't safe at all. Trust evaporated. Banks stopped lending to each other. Liquidity disappeared, and the global financial system began to suffocate. 8 million Americans lost their jobs. 6 million families lost their homes. Global markets lost over $10 trillion in value. Governments rushed in with emergency bailouts, not for homeowners, but for banks. Institutions deemed too big to fail. No single villain caused the crash. It was incentive. Bonuses for issuing loans, fees for bundling risk, profits from insurance bets. At every level, the system rewarded short-term gain and pushed long-term danger onto everyone else. If the financial system collapsed once by design, what makes you think it can't happen again?